My name is Mike Hoffman. I'm the director of the Center for Business Ethics here at Bentley. And I'd like to get started. Ladies and gentlemen and students of Bentley University, fellow faculty members and staff, and distinguished guests, I'm delighted to welcome you to the Verizon Professorship in Business Ethics and Information Technology. And I want to thank you for coming. For over 3 decades, I have been the director of the center, and I have had the pleasure and opportunity to introduce many distinguished speakers who have addressed many important topics. Today, through the generous support of Verizon, we continue this tradition by focusing on the topic of ethics and enterprise risk management. And the importance of today's topic can be measured, unfortunately, in painful statistics such as an unemployment rate of almost 10%, a decline in gross domestic product, increase in homelessness, and a decline in world trade. The fact is that for over 2 years, the global economy has been mired in the worst economic crisis since the Great Depression. It will take more time before there is a final accounting of the causes of this calamity, but no one disputes that a major factor can be found in the failure of our financial institutions to adequately manage risk. This is a topic that we at Bentley must think about seriously. It is a topic of great ethical concern and complexity. And to begin to understand it, we need a wise and skillful guide. There are few who are better qualified to help us navigate this treacherous territory than Professor John Boatright of the Graduate Business School of Loyola University of Chicago. Before introducing Dr. Boatright, I would like to recognize that today's event and the other lectures and workshops that Dr. Boatright will be giving here at Bentley during this week would not be possible were it not for the generous support of the Verizon Foundation. I am particularly pleased and honored that Mr. Greg Miles, who is the director of Verizon's Office of Ethics and Business Conduct, has traveled from New York to be with us today. We are grateful to Greg and his colleagues for the faith they have had in our mission to help advance business ethics through this forum. So let us begin by welcoming Mr. Greg Miles. Greg? I would also like to recognize a longtime friend of the Center for Business Ethics and Bentley, who I just spoke to and said he's enjoying retirement thoroughly, and that is Mr. Dave Rainey, who was ethics officer here in the Boston area for Verizon and then down in New Jersey. He seems too young to me to be retired, but David, stand up and say hello. And thank you also for coming up. Before beginning our program, I'd like to remind everyone about an important matter of protocol, and that happens to do with this. Mine is a Verizon phone, and I'd like to remind you to turn it off so that it won't disturb the lecture. And in order to make this event as engaging as possible, there will be a question and answer session immediately after the formal presentation. Some of you may have to leave before Dr. Boatright has completed his talk, and if so, please be sure to do so as quietly as possible, and I know you will. Thank you. Bentley is a partner in the Forum Network, which provides webcasts of public lectures from the nation's leading cultural and educational institutions. Dr. Boatright is kindly allowing us to record his lecture in order that it can be included in this collection. So if you would like to view the lecture at a later time, you'll be able to find it at forum-network.org/ that's it. And search for Bentley University when you go there. That's forum-network.org/. Before I talk to you about Dr. Boatright's stellar credentials, I want to first inform you that we recognize that one can build a hearty appetite listening to a thought-provoking speech. And for this reason, you are all welcome to attend a reception with food and drinks following the lecture, which will be held right in this building on this same floor in what is called the foyer. There you can also meet our speaker and pose any questions you may have to him. Let me now say just a few words about Dr. Boatright, who I've been friends with for probably longer than we'd both care to remember. In addition to his position as the Raymond C. Baumhart Professor of Business Ethics at the Graduate Business School at Loyola University of Chicago, Dr. Boatright is the author of Ethics and the Conduct of Business and Ethics in Finance, and is currently editing a forthcoming volume, Finance Ethics. His writings appear in numerous journals and book chapters. His current research focus is on ethical issues in finance and corporate governance. Dr. Boatright has lectured around the world, but this is his first time at Bentley, and our having the pleasure to hearing his remarks. Besides today's lecture, he will be speaking in 6 classes, and he will also be holding a faculty and staff interactive breakfast workshop on Thursday morning here in a Damien building in the Commons. So, ladies and gentlemen, it is my pleasure now to introduce you to our speaker, Dr. John Boatright.
Thank you very much, Mike, for that very fine introduction. I will do my best to live up to it. And I'm very, first of all, pleased to be here at Bentley University. And contrary to what Mike said, I've been here a number of times before because of the great activities of the Center for Business Ethics. So I trust that everyone at Bentley appreciates the role that the Center for Business Ethics has played in the development of the field, especially the great work that Mike Hoffman has done in developing the center. And I'm also very honored to be here as the Verizon visiting professor. And again, I thank the people from Verizon for sponsoring this very fine lecture. I want to talk to you today about a very important topic, especially in the context of the current financial crisis, and that is enterprise risk management. Now, as I will explain, risk management has been with us for a long time, but the phrase enterprise risk management and the movement that it denotes can be actually fairly precisely dated from about 1995. So this is a movement that's about 15 years old. So as you know, in business, change is constant. Products change, production methods change, business thinking changes. And some of these changes are simply fads that come and go, others endure. So 15 years is a fairly long time, but still, enterprise risk management might be a fad, or it might be, again, a very prominent movement that will be with us for a long period of time. And enterprise risk management has become an established part of business. Probably most Fortune 500 or 1,000 or 1,500 firms have programs of enterprise risk management. And some of these are headed by a new figure known as the Chief Risk Officer. And enterprise risk management has also come to play a very important part in business education. I note that here at Bentley, the MBA program has a specialization in risk management. It appears that about half the faculty is associated with it, which suggests that Bentley takes a rather broad view of enterprise risk management. And at my own institution, we've established a center for enterprise risk management and corporate governance. And in a nod to Verizon, enterprise risk management would be impossible without very sophisticated information technology. That is, it requires computers of considerable power, very sophisticated computer programs, and immense databases. So part of the reason why we can date it to about 1995 is that's the time at which a number of forces came together, one of these of which is information technology. And finally, as Mike mentioned, this topic has acquired a great deal of interest because of its alleged role in the current financial crisis. Rightly or wrongly, the current crisis has been blamed on, among other things, risk management. Certainly the banks took a great many risks, but some risks are worth taking. But the view is that the banks took unwise risk. However, the current financial crisis is not due to a lack of attention to risk management. If anything, the banks and other institutions that have been involved in the current financial crisis took risk management very, very seriously and analyzed to a great degree the amount of risk that they were taking. Indeed, one of the things that may have given them confidence, some institutions were leveraged, for example, 30-to-1, was that, well, we can be leveraged 30-to-1 because our risk management systems are so good. So it may have led to perhaps a faulty use or perhaps a over-reliance or unwarranted confidence in risk management. Now, there's immense literature in enterprise risk management. If you do a library search or if you Google this, you'll come up with a tremendous number of hits. So again, the material on enterprise risk management is truly daunting. However, there's actually been very little written on what we might regard as the ethical aspects of enterprise risk management. And indeed, I feel that I'm really beginning almost from the very beginning in trying to explore this field. Now, this may be due to several reasons. One may be the view that enterprise risk management is a kind of purely technical, value-free enterprise. It's a kind of engineering. However, as we know, even engineering, building bridges and airplanes, also raise a great many ethical issues. I think there's also the belief that enterprise risk management is a kind of unalloyed good. What do we want companies to do? Ignore risk? Take too many risks? So that we really want our corporations, business firms to pay attention to the risk that they take. Indeed, the more, the better. However, I think that enterprise risk management does raise a number of very, very interesting ethical issues. First of all, it raises ethical issues simply as a phenomenon. Since this has developed since about 1995 and grown into such a big enterprise, we can view this as a kind of interesting phenomena. So we need to understand why it has developed. And in its implementation, in the actual practice of enterprise risk management, I think it also raises a number of issues. Among other things, it holds out a certain promise. It says we can do this. And so it can actually fulfill its promise. And finally, I mentioned, of course, its role in the current financial crisis. So we need to ask, has it failed? And if it has failed, why has it failed? And what can we do in the future to make sure that it doesn't fail again? Now, let me give a very brief history of enterprise risk management, because risk management itself has been with us for a long time, and it's enterprise risk management that's the more recent development. In his really fascinating book, which I encourage everyone to read, Against the Gods, The Remarkable Story of Risk, Peter Bernstein sort of traces the dividing line between ancient and modern times in the discovery during the Renaissance of statistics. Prior to that time, according to his account, events were viewed as essentially random, capricious, perhaps the result of the whims of the gods who had to be placated. But with the discovery of statistics, they found that there were regularities that could be measured, and human beings could take the future into their own hands. And so he gives them, again, the story of the development of the modern statistics. And this then became the foundation of modern banking and insurance. So for several generations, we have had banking and insurance institutions. And statistics are also, of course, used by government to manage risk, and government is a major manager of risk in any society. In fact, Bernstein reminds us that the very word statistics comes from the numerical facts that are used in the administration of the state, state statistics. So again, for a number of centuries now, we've had banking and insurance and specialists in those areas. But around 1970, there was the development of the risk manager, development of risk management. And this risk management was primarily a function which, first of all, assessed the risk that a company or firm was taking to advise upper-level management, and also to have a kind of policing or cop role to, in some cases, veto certain risky transactions. And this arose about 1970 for a number of reasons. One was that the nature of banking was changing. And part of the story that I will tell is the changes that have taken place in the banking industry. Up until about 1970, banking was a fairly staid enterprise. Banks took in deposits, made loans, and managed the risk for society. After that point, many banks began to advise firms not only on takeovers, but also, and to provide the financing for those takeovers, but also to invest in them themselves. And banks and other financial institutions began to trade more for their own account. And in doing this, they took on a much greater risk exposure. And much of this was facilitated by advances in the field of finance. Thus, for example, the capital asset pricing model and option pricing theory gave a basis for banks to make these kinds of investments. And the goal of banks then became not so much to avoid risk or to reduce risk, because some risks are very much worth taking, but rather to optimize the risk-return trade-off. So one lesson we get from modern portfolio theory is that there's all sorts of levels of risk with the associated level of return. So the point is not to, again, avoid or reduce risk, but to find those risks that are worth taking, to be on the efficient frontier. And in this development of risk management, risk managers themselves were typically statisticians, actuaries, applied mathematicians, people we would ordinarily call quants. Now, in 1995, a number of things changed. First of all, firms discovered that the traditional risks, which were usually viewed as credit risk and market risk, were supplemented by other kinds of risk. For example, in 1995, Barings Bank, which had been in existence for several hundred years, collapsed because of the trading activities of a rogue trader named Nick Leeson, based in Singapore. And the cause was traced to the lack of oversight of managerial systems to control trading activity. Thus was born the idea of operational risk. So instead of just credit risk and market risk, we now had operational risk. In the same year, Shell Oil was considerably damaged by two events. One was an attempt to dispose of an oil storage facility in the North Sea called the Brent Spar, which was opposed by, among other organizations, Greenpeace. And Shell was ultimately forced to bring it ashore and dismantle it rather than dropping it into the North Sea. In the same year, Shell also suffered great damage from their operations in Nigeria, from accusations of their human rights record there, and in particular, not to oppose the execution of an activist named Kinsaro Wiwa. And so because of these events, reputational risk was born. So again, in 1995, companies became aware of the range of risks that they were taking, or more precisely, these had always been present but these were now identified as risks to be managed. Secondly, they recognized that the risks that they faced were linked. There was one risk here, one risk there, but they were also interact. And so risk had to be treated not in silos, one at a time, but rather had to be treated together with all of their dynamic interrelations. And thirdly, companies realized that risk needed to be addressed by the top-level executives. It was no longer sufficient just for quants, low-level figures, to simply assess and advise on risk. It was necessary for the C-level officers, the CEO, the CFO, and also for the board to pay attention to the risk that the company was taking. And also outside firms, there was a much greater demand by the public for responsibility and accountability. As the public was demanding, that companies recognize their risk and take active steps to manage those risks. And there was also the development of the sociologists. One sociologist, Frank Ferretti, described as the culture of fear. He wrote a book by that name. At the same time, there were a number of other sociologists, such as Ulrich Beck and Anthony Giddens, who developed the concept of the risk society. Their view is that somewhere in the late 20th century, around 1990, society became much more obsessed with security and greater demands that the risk to life be addressed. And that was also spurred by the recognition that modern society creates more risks, as many risks are man-made. And furthermore, in the move from traditional to modern society, which occurred around the turn of the 19th century, that many of the protections against risk the traditional society had provided had been removed. So now we have enterprise risk management, which differs from more traditional risk management in three ways. First of all, it's more comprehensive. That is, we have, in addition to the traditional credit and market risk, we now have operational risk. We have reputational risk. We have strategic risk. And in fact, the sociologist Michael Powers sort of satirizes this movement with a book with the title of The Risk Management of Everything. That is, everything has now become the subject for risk management. Secondly, risk management has become integrated, as it's no longer dealt with in simply silos, piecemeal, one at a time, but rather across the whole enterprise, hence the term enterprise risk management. And third, high level. That risk management is now a function of the C-level officers of a company, as well as a major board responsibility. And again, many firms now have created the position of chief risk officer. Actually, that's a misprint, isn't it? Should be CRO, chief risk officer. Now, one of the organizations that has supported the development of enterprise risk management is the Committee of Sponsoring Organizations of the Treadway Commission. So in the middle 80s, there were a large number of accounting scandals. And so there was formed what was called the Treadway Commission, which issued the Treadway report. And that was backed by an organization which exists today, COSO, or the Committee of Sponsoring Organizations of the Treadway Commission. So they define enterprise risk management, as you see on the screen, as a process effected by an entity's board of directors, management, and other personnel, applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite, to provide reasonable assurance regarding the achievement of entity objectives. And COSO then identified sort of 8 components of enterprise risk management. First of all, the internal environment. That is the company's attitude or philosophy of risk. And that also includes the moral tone of the organization and the company's ethical values. Secondly, the way in which the organization sets its objectives, then identifies the risks that it faces. And this includes not only, of course, risks that can cause harm, but also risks that create rewards, provide opportunities. And assess those risks, which includes the likelihood of the event occurring, as well as the harm that the event can do to the organization. And then develop a variety, a repertoire of risk responses. How is the company going to respond to these risks? Control activities to make sure that these responses are carried out, and that relevant information is gathered and communicated across the organization. And finally, monitoring the whole process. Thus, COSO developed a model which is in this diagram. So we see the 8 components along one side of the cube. Along the top, we have the various functions of the organization: strategic, operations, reporting, compliance. And on the other side of the cube, we have all the levels of the organization: the whole entity level, the division level, the business unit level, and the subsidiary level. So this is the kind of model by which we can visualize what enterprise risk management actually consists of. Now, I'm going to address now why has enterprise risk management developed, and in particular, why did it develop around 1995? Now, one answer I'm going to reject is that the world really is more risky. That is, today we actually face more risks than ever before. These risks are more likely to occur. These risks are more severe in their consequences. And there were many risks that occurred in the world, but the business was not particularly exposed to, such as, for example, country risk, political unrest. Now, certainly the world is a risky place. I don't want to deny that. But has the world suddenly become all that much more risky, especially around 1995? So at least I would maintain that in the modern developed world, it's probably less risky than it ever has been in any time in human history. But we can debate that. But furthermore, business has always had a great deal of risk. We have, for example, Joseph Schumpeter's creative destruction of capitalism. Firms come and go. This is just the way capitalism works. And finally, we need to account for its fairly quick and widespread adoption around the year 1995. So what I'm going to offer are sort of 2 other explanations. One is there's been a very significant shift in regulation from what I'll call rule-based to risk-based. And secondly, that banks have discovered very new profitable economic opportunities, which require the very careful management of risk. And again, both of these developments to risk-based regulation and to these new financial instruments have been facilitated by advances in information technology. Now, we're all familiar, I think, with rule-based regulation because that's the model most of us use to think about the kind of government regulation that we have. First of all, there's a very sharp separation between the regulator and the regulatee. Usually the regulator is some government agency, and the regulatee is a business firm that needs some regulation to protect the public. And the agency, the government agency, then creates rules to be followed. In the case of banking, this consists primarily of rules to sort of enforce sound lending practices and investment practices on the part of banks, and also to maintain adequate capital reserves. And most of these rules address the traditional risk of market risk and credit risk. And there's some obvious advantages of rule-based regulation, but there are also some drawbacks. For one, it creates a kind of adversarial relationship between the regulator and the regulatee. Thus, business firms have very little incentive to cooperate with their regulators, and also very little incentive to self-regulate on their own. And furthermore, there are simply limits to rules. That is, it's very difficult for a government agency to set rules which deal really with the complexity of the enterprise, especially in banking. There's also the uncertainty about the situations that will arise and what rules should apply in those cases. There's a great information asymmetry between the regulator and the regulatee. So typically banks know a lot more about their own activities and the risks that they are taking than the regulators have. And furthermore, innovation, which is ever present, creates new situations to which rules may not apply. Indeed, a great deal of innovation is designed precisely to get around regulation. So it's really difficult for regulators to keep up with that kind of innovation. And again, the kind of rules that are developed by regulatory agencies are not very good in dealing with operational risk. So now we have a system of risk-based regulation in which the focus is not upon the regulator's ability to create and enforce rules, but rather the regulated entity, say a bank, is required to have its own internal control system in order to identify, and measure, and monitor, and respond to all the risks that it faces. And then the job of the regulator is to review the model that's been developed by the regulated entity. And these models then become, again, integral to the decision-making processes of the firm. So here we have a system of regulation which then becomes integral to the firm itself. And typically, risk-based regulation expands the concept of risk, not from merely credit risk or market risk, but also to operational, reputational, and even strategic risk. So in a system of risk-based regulation, the regulation is proportioned to the level of risk. Thus, banks can never be risk-free. We would not want them to be risk-free. We might want them to take, part of the role of banks is to manage risk on behalf of society. So it's essential that they take risk. And some banks may be more risky than others, and that's okay, as long as the greater degree of risk is accompanied by a greater degree of internal controls, systems for regulating risk. So I think the advantages of risk-based regulation is, first of all, it provides more flexibility in the selection of the level of risk. So banks and other business firms themselves can decide, how much risk do we want to take? Because after all, risk is correlated with reward. And so we may want to take great risk in order to achieve great rewards. So we can have banks that have different levels of risk rather than a kind of one-size-fits-all level of risk. Secondly, I think risk-based regulation sort of normalizes adverse events. That is, bad things are going to happen. Losses are going to occur. And that has to be accepted. But I think we're more willing to accept those kind of losses if we feel that they were done despite very adequate control measures. And finally, risk-based regulation is much better suited to operational risk. So there's been a great deal of support for risk-based regulation. One of the early supports came from the Treadway Commission, again, supported by COSO, in 1987. The federal sentencing guidelines in 1991 placed a great deal of emphasis upon a company's internal control systems. The Sarbanes-Oxley Act of 2002 did the same, including the infamous Section 404 that's drawn so much criticism, which requires public firms to be able to test their internal control systems. And of course, this is not just a US phenomenon. In the UK, there's been 1992, the Cadbury report, later the Turnbull report, and in Canada, the Day report, which all come to pretty much the same conclusion. But in banking, by and far and away, the biggest force has been the Basel II Accord, dating from 2004, in which the Basel organization attempted to provide guidance to countries in the level of capital requirements for their banks. So the Basel II Accord then bases capital requirements on the level of risk that the company is undertaking, and it can effectively manage. So again, banks are called upon to establish their own models and to determine, according to those models, how much risk they're actually taking and also how well they are managing those risks. And Basel II explicitly mentions operational risk in addition to credit and market risk. And it also calls for a high level of responsibility. that, again, risk be managed at the highest levels of the organization. So one way we can view this is that the whole idea of risk-based regulation is pretty much the same as enterprise risk management. So as our world is moving toward more risk-based regulation, then the response of businesses have to be to develop enterprise risk management. So again, Michael Power in his book, Organized Uncertainty, writes that in a relatively short period of time, the private world of organizational control systems has been turned inside out, made public, codified, standardized, and recategorized as risk management. Okay, so one of the forces behind enterprise risk management has been this change from rule-based to risk-based regulation. Now, there are a number of benefits, I think, to enterprise risk management. However, these would not be apparent from finance theory. One famous premise of modern finance, the Modigliani-Miller theorem, is that investors will not reward companies for managing risk because investors themselves can adjust their own portfolio to get the desired level of risk. So in a world of perfect markets, again, there would be no incentive for firms to manage their own risk. Investors would do that themselves in the formulation of their own portfolios. However, these same investors don't like volatility. So one explanation in finance theory for managing risk is that firms at least want to reduce their volatility in earnings or stock price or by other measures. But there are other possible explanations. One is that some firms can have a comparative advantage in the management of risk. So certainly insurance companies take on a great deal of risk precisely because they have the competence in managing risk, and that's their source of income. And also, another explanation that's been offered is extreme risk avoidance. By that, I don't mean extreme risk aversion, but rather an attempt to avoid the most disastrous things that can happen to a company, the kind of things that keep executives awake at night. So Renee Stoltz, for example, has called this a very much out of the money a put option. So if the firm should collapse, again, a very improbable scenario, at least the firm will be worth more as a result of engaging in enterprise risk management. But I'm going to offer two other accounts here. One is that around 1995, there was the development of more precise methods of measuring risk. And there are a number of these, but one I'm going to focus on, and one that's received a great deal of attention, is called value at risk, or VAR. And the second is the development by banks of, again, new financial instruments for, most would say, managing risk, but critics might also criticize them for taking risk. And the most prominent instruments here are collateralized debt obligations, CDOs, and credit default swaps, CDSs. So these are two rather arcane, very recent developments that have now become part of our common vocabulary. We read about them all the time in the newspaper because of the role which they have allegedly played in the current financial crisis. And again, it would not be possible to compute VAR or to create CDOs or CDSs without the computing power, the computer programs, and the databases that are provided as part of information technology. Now let me first of all look at value at risk, which is simply an amount which is expressed in monetary units, that is so many dollars, of the maximum amount that can be lost in a portfolio on a given day or over a period of time within a certain degree of probability. At least according to Wall Street lore, VAR was developed at JP Morgan when its chairman, Dennis Weatherstone, wanted to have at the end of each trading day a record of exactly how much risk JP Morgan was taking. These became known as 415 reports. That is, at 4:15, this report was supposed to be on his desk. And it would state something like, with a probability of 95%, or 99.5%, or 99.9%, The most that we could lose on a portfolio of, let's say, $1 billion over a 30-day period would be, say, $50 million. Now, this provides really a kind of single number, $50 million, to give some idea of the risk that the firm was taking, sort of a kind of bright line test. Anything below that's okay, anything above that is not okay. And furthermore, it applies to all kinds of transactions. So all of the kind of transactions that firms such as JP Morgan would be engaging in could be used with the same measure. And indeed, the whole portfolio could be assigned a value at risk number. Now, there are a number of prominent criticisms of value at risk. One is that it encourages a kind of false sense of security. Okay, we know the most that we can lose with, let's say, 99.5% assurance. So let's stay with that amount. Let's be very risky, because it seems as if we have our risk under control. Another prominent criticism that is VAR sort of ignores very low probability events. But these can be the very ones that can have very high impact upon the organization. And so if we think about the worst that can possibly happen to a firm, it could be very, very bad. But yet, that's not going to happen according to, let's say, a 99.5% degree of probability. So if we're dealing with events that only occur once a century, or once every 1,000 years, then common sense would say that we need historical data that range over at least that period of time. But very often, VAR was not accompanied with data over a sufficiently long historical period of time. That is part of the cause of the current financial crisis, the view that housing prices never fall. But they did fall dramatically in 1932. So if our data goes back to 1932, that will be recorded. But if we only go in the last 30, 40, or 50 years, that's not going to show up in the VAR number. And then the difficulty of really precise measurement of very improbable events. So some of you may have read the book by Nassim Nicholas Taleb, Black Swans, or there's another book by Ricardo Rabinato called The Plight of the Fortune Tellers. And they focus on the difficulty of measuring very improbable events, the so-called fat tails or black swans. Typically, a VAR calculation would not include liquidity risk, but we discovered in the current financial crisis that that is a very important risk. Thus, we can be assured, for example, that Bear Stearns measured very precisely the risks they were facing from, let's say, increased defaults or from an increased interest rates. But they depended every day upon turning over their debt in the short-term paper market. So they woke up one morning and discovered that no one would loan to them. Again, not because interest rates had gone up or something else had happened, but because people no longer trusted Bear Stearns. So they faced a liquidity crisis which hadn't been calculated into their VAR number. And it does not take account of correlated events. So typically there will be a certain number of housing defaults. And so if we diversify our portfolio and have mortgages from Southern California, from Las Vegas, from Southern Florida, and say Detroit, these are all in different parts of the country. But what they fail to recognize is that mortgages may be defaulted on for exactly the same reasons all across the country. And finally, the VAR figure can also be gamed by very clever traders. Just one example would be traders could have investments in securities that have a fairly low but steady return over the whole range of its distribution scale, except that it falls off very sharply in a few cases, in which case the firm could be subject to very great losses, but still with a 99.5 degree of probability, those losses will not occur. And finally, VAR typically measures specific risk, but not systemic risk. For example, Richard Posner in his new book on the crisis of capitalism points out that each firm could have a 1% failure of collapse. But if that then translates into a 1% collapse of the whole society could face a new depression, that's a risk that we don't want to take. So that risk that could be rational for for each bank may not be rational for society to take. So again, that's VAR as a measure of risk has some of the problems that I've just elucidated. Now, the other factor, aside from developing more precise risk measurements, which have induced banks to undertake enterprise risk management, is there's a lot of money to be made in new financial instruments. So again, up until, about 2 decades ago, banks were primarily engaged in taking in deposits, making loans, and then making a profit on the spread between the interest rates and also on bank fees. But banks then wanted to make more money. Well, how can we make more money? They developed what Joseph Stiglitz has called hedge fund envy. They wanted to be much more like hedge funds than traditional banks. Well, there are 2 ways in which banks can do this. One, they can simply sell their loan portfolios. So much of their capital is tied up in the loans that are on their books. So if they could sell these loans to other investors, then they would then be freed up either to make more loans or to engage in trading. Or they could insure their loans, find some insurance company, let's say AIG, who would insure the loans that they have on their books. Again, the risk would then be off their own books, and again, they could either make more loans or, as turned out to be the case, engage in more trading. So I assume, again, because of their role in the current financial crisis, many are now familiar with CDOs and CDSs. But for those who are not, collateralized debt obligations are simply securities that are taken by putting together a large number of other loans. Thus, a bank can take hundreds or thousands, even tens of thousands of loans on their books. And again, these can be mortgages, auto loans, business loans, consumer loans, and so on, and put them together in one security, and then sell that security to investors. This is the process known as securitization. And in this process, these securities can then be divided into, first of all, strips, as we can separate the principal payment from the interest payments. And they can also be divided into tranches, so that the lowest tranche would be the first loans to default, whichever loans those happen to be. So if you were the holder of the lowest tranche of a CDO, then you would bear the first losses that occur as the result of defaults. But then further up the line, the highest tranche would be those that would be last to default. So quite obviously, the lower tranches are going to be very risky, but they're going to carry a very high interest rate just because of the riskiness involved. The higher tranches are going to be very safe, or at least they thought they would be very safe. Because if you're in the highest tranche, then perhaps 90% of the mortgages or other loans have to default before you are going to be affected. And credit default swaps function essentially like insurance policies. So a company, again, such as AIG, would insure the loans that are being held by an investment bank, say JP Morgan Chase, so that the loan holder would then be compensated in the event of default by the borrower. I think both CDOs and CDSs raised an interesting problem, question about exactly how they can create value. Because in theory, there's not too much money to be made here. Because if a bank is going to sell its loans, it's going to sell both the principal and interest payments and also forego the risk premium they would otherwise achieve. And whoever buys the loans is probably not going to pay more than the discounted present value of the future interest and principal and interest payments. So the whole thing really should be a wash. And the same thing would apply to credit default swaps. That is, if AIG is going to insure these loans, they're going to demand a premium that compensates them for the risk that they are going to be assuming. So there are 2 ways in which value can be created by these kinds of financial instruments. One is simply through more efficient risk-bearing. So part of the theory behind CDOs is that the risk is being transferred to the whole market. So a relatively risk-averse bank can now transfer this to investors worldwide. And you can't get more diversified than the whole world market. Furthermore, the investors in the world can then pick and choose the exact risk that they want to assume. So we can have a closer matching between the risk preferences, the risk and return preferences of investors and the securities that are being offered. So if you have a loan, a single mortgage, that's what you get. But if you have a tranche of a security, then again, you can choose exactly the degree, the balance, trade-off between risk and reward that you prefer. So part of the theory is that the whole market can bear the risk of loan default much more efficiently than can the bank itself, and therefore there's value to be created. So that's one possibility. That's sort of the virtuous side of CDOs and CDSs. The other side is that the security may be mispriced. That is, the CDO may be sold to investors who underprice the risk that they are, in fact, assuming. Or if it's a matter of a credit default swap, that the insuring company, again, misprices and demands too low a premium for the risk that they are assuming. So if you want the story of the current financial crisis, that's a good part of it right there. Namely, that risk was mispriced. Of course, that raises a very interesting ethical question about transferring risk when there's a chance that it is being mispriced. You know, is that ethical or not? Because that's what trading is all about. If you're a trader trying to sell a security, you want to find an investor, a buyer, who either values that security more than you do, or who undervalues the risk more than you do, or preferably some combination of the two. So the security is going to end up in the hands of the buyer who, again, values the asset more or rates the risk less. But who's to say that a security is mispriced? Ordinarily, we simply leave that to the market. So if there are buyers out there for CDOs, or if you can find a company that's willing to insure your loans with a credit default swap, then just let the market determine what the appropriate price will be. But what we've discovered is that in this market, there's a great deal of information asymmetry. That is, typically the bank knows a lot more about the value of these securities than does the ultimate investor in the case of CDOs or the insuring firm in the case of credit default swaps. But still, ordinarily in a free market, we let buyers and sellers take their lumps. So if one party makes a mistake about the value of a security or about the degree of risk, then there will be a wealth transfer from those who are able to price the security or the risk more accurately to those parties from those who misprice it. So why not just let the market work and let those who have better information and better pricing information take their gain. But the problem is, what if there's a moral hazard? That is, what if the bank is not going to pay the full price, but rather this is going to be transferred to the shareholders or the taxpayers? For example, if this is a bank that has federally insured deposits, then ultimately the taxpayer, rather than the shareholders themselves, will be the ones who will pay the price. So there's the problem of moral hazard. Or what if the market is not clear? That is, what if the losers in these transactions cannot actually pay the winners? Well, then there are going to be ripple effects through the whole market economy and creating there what we call systemic risk. Or what if the other traders are not very sophisticated? Is there any obligation to look out for their interest? For example, Lloyd Blankfein, the CEO of Goldman Sachs, was called before Congress to explain why Goldman Sachs was shorting the very CDOs that they were selling to investors. That is, they were packaging loans into CDOs and selling them to investors, and at the same time trying to bet that these securities would fail. Well, his answer was, well, we were dealing with sophisticated investors That is, there are investors out there who had a different view about the value of the risk and wanted in many cases to assume this risk, so we simply let them do so. Well, Phil Angelides, who is chair of the current congressional committee, responded, well, these sophisticated investors were acting on behalf of school teachers and police officers and so on, who in many cases are very unsophisticated investors. So again, we question whether it's ethical to transfer mispriced risk. Okay, now I'll get to what presumably is the main topic here in the time that remains. That is the ethics of enterprise risk management. And here we're going to raise several questions. One is, does it work? Can enterprise risk management actually deliver on its promises? And that question has two parts, because as we already noted, that part of the motivation for enterprise risk management is as a basis for risk-based regulation. So we can ask, does it work as a basis for regulation? That is the emphasis of Basel II on risk-based regulation one that's going to work? And also as a basis for effective corporate decision-making. And also, is enterprise risk management a good idea? That is it really, as COSO maintains, an efficient decision-making framework? So does it work? Well, in the case of VAR, we've already cited the problem of trying to model very rare events. So that risk management is based upon modeling where we rely primarily upon normal distributions. But for that, we're going to need historical data, especially for tail events, which again may occur by our statistics only once every 100 years or every 1,000 years. And do we actually have the historical data that would make this possible? And also, what about the worst case scenario? Presumably, enterprise risk management is developed for those executives, for those things that keep them awake at night. Well, those are the very worst things that can happen. And if we calculate this according to value at risk, we're talking beyond the horizon of 95% or 99% or 99.5%. VAR doesn't even attempt to determine what's the worst that can actually happen. Furthermore, do all of the events that we're concerned with have a knowable distribution? That is, that they can be arrayed in a curve of some shape. So again, this can be true for events that occur with some frequency. But again, how about for those very rare events that, again, we want to protect against? And this raises an issue in statistics about the interpretation of probability. So if you take a course in statistics or probability theory, you'll learn the distinction between the frequentist interpretation, from which we know, for example, that a coin toss will be, on average, 50% heads, 50% tails, and the Bayesian interpretation, which is not simply the frequency of events, but rather the degree of probability that we can place in events. Thus, for example, we know a coin toss would be about 50% heads, 50% tails. But how about, is there life on Mars? Well, again, we can have a certain degree of probability. When we say there's a certain degree of probability, we can say the evidence supports to this level a belief that there is life on Mars. But again, we can't express that in the same way that we express a coin toss. But this is also expressed very famously by Frank Knight, an economist at the University of Chicago in the 1930s, where he made the distinction between the known unknowns and the unknown unknowns, which Donald Rumsfeld also made famous in the context of the Iraqi war. Thus, we don't know the outcome of the next coin toss, but we do know that on average it would be heads 50% of the times and so on for tails. But then there are the unknown unknowns, completely events we in many cases can't even imagine. How can we model those? For example, suppose a Martian came to Earth and found a coin. What basis would the Martian have for knowing what the probability of heads and tails in a toss might be? Or the Martian might be very surprised to find that a coin could be exchanged for, let's say, a candy bar. So those are the kind of events that, again, we can't put into a frequentist interpretation. So those are the unknown unknowns, which, again, we want to know about if we're going to manage risk. There's also what, again, Michael Power calls the problem of displacement, which is that there are certain things that can be measured and certain things that can't be measured. So there's a tendency to simply take those things that can be measured, measure those, and make our decision on the basis of those events. That's sort of like the joke about the drunk who lost his keys in the bushes and was looking under the streetlight. And when asked, he said, well, the light's much better here. So again, there's a temptation to simply take what we can see well and look at that rather than things that we really should be looking at. And then there's the problem of whether a knowledge of probabilities affects the outcome. Thus, for example, the weather can be predicted with a certain degree of probability. And if the weatherman says it's going to rain and everyone takes their umbrellas, that's not going to affect whether it rains or not. On the other hand, in finance, on a day-to-day basis, there's a certain number of buyers and sellers such that the movements in the market are essentially random, as postulated in a random walk down Wall Street. But in time of a crisis, then everyone tends to act in the same way. There's a flight from risky assets to more safe assets. And so people's computer models tell them, again, to sell. And if they all try to sell together, let's head for the exits together, the result is going to be calamitous. So we find that the models we have are developed for everyday events. We find that in times of crisis, when everyone tends to act in the same way, the models tend to break down. And is it a good idea? Well, again, Peter Bernstein has called enterprise risk management, a new religion. Again, we become captivated by these statistics and we simply follow them religiously. Or we could say it also creates a false sense of security and may actually increase the amount of risk-taking, in some cases very imprudent risk-taking. Again, as I've suggested, in the current financial crisis, when banks and other institutions undertook a great deal of risk, they did so in the belief that their risk managements were so good that they could take these risks safely. Or we might have the opposite. Thus, for example, some writers have argued that companies have become too risk-averse. Benjamin Hunt, for example, wrote a book called The Timid Corporation, or there's another book called Cowardly Capitalism. So the view is that placing too much emphasis on risk management may actually incline some firms to be less risk-averse, more risk-averse than they should be. Furthermore, in enterprise risk management, we have to pay very careful attention to exactly how responsibility is allocated. So one of the movements has been to move risk management from a fairly low-level function of the so-called quants up to the C-level of the CEO, the CFO, and maybe even the chief risk officer. But that may have the effect of actually increasing the risk because such persons in such positions simply receive the data but may not know how to interpret it. Whereas the people who create the data understand exactly what it means, what its limits are, and so on. So at least some have argued that in moving the level of responsibility up, we have put it at a higher level, but we put it at a level in which the information is less effectively applied. And that simply moving up to the high level releases everyone else of the responsibility. And a very interesting area, I think, is how enterprise risk management impacts corporate social responsibility and so-called corporate citizenship. So some people here have seen a great opportunity because enterprise risk management a company that practices enterprise risk management looks an awful lot like a company that people would characterize as a good corporate citizen or as being a socially responsible corporation. And especially if we include reputational risk, then this is the way in which groups that have concerns can register those with the firm, and the firm itself can take those concerns into account. So it may well be that enterprise risk management sort of advances the agenda of those who advance the cause of corporate social responsibility or corporate citizenship. And finally, a very big area is the risk always shared, shifted, or whatever is done with it responsibly. By my account, there are about 8 things you can do with risk, and it's very important exactly how you respond to risk. So I think one criticism of enterprise risk management is that it focuses much too much on the assessment of risk and less upon the responses to risk. And so exactly how firms respond to risk, I think, is an important consideration that needs to be taken into account. So my conclusions. First of all, is enterprise risk management simply a fad? Well, I think not, because I think the forces behind it are so strong. That is, there is a big movement toward risk-based regulation that will continue. The financial firms will find it increasingly profitable to engage in financial innovation, which requires the very careful management of risk. And also, I think that the public will continue to demand that firms manage their risk responsibly and be accountable for it. And can it work? Well, again, I think this probably can. But again, we need to be aware of its limits, most of which are with, again, very improbable events, again, the worst that can happen. You know, the problem of correlations and convergences which occur in crises. So the enterprise risk management is very good at managing the ordinary risk of business. But when crises occur, it may well turn that all bets are off. And is it a good idea? I think it is, but I think we need to avoid a kind of over-reliance upon risk management. Make sure that we allocate the responsibility for it wisely, and shouldn't go without saying, to simply manage the risk responsibly. After all, ERM is only a tool. So how it's actually used by management is very critical. So I'll conclude where I began, with Peter Bernstein and his book, Against the Gods. He writes in the introduction, the story that I have to tell is marked all the way through by a persistent tension between those who assert that the best decisions are based on quantification and numbers, determined by patterns of the past, and those who base their decisions on more subjective degrees of belief about an uncertain future. This is a controversy that has never been resolved. Well, Peter Bernstein did not resolve it. I don't think that in my talk today I have resolved it. But with the development of enterprise risk management, we need to think very carefully about how corporate decisions are made and the extent to which they should be made in accord with, again, the models that are in use and the extent to which other means should be used. So again, I feel I've only touched the surface of the very rich area of enterprise risk management, but I hope I've given you a brief introduction that whets your interest. And as the students here go forward, not only in your education, but also in your career, again, I think you will run into enterprise risk management again and again, more and more. And this will give you some background for dealing with it. So again, thank you for your attention, and I'm pleased to be here. Q&A?
Yes, we do. I'll let you have it.
Okay. Are there microphones? Are there microphones?
The microphones are on their way.
The company and rights of people who might be harmed. And if you could just elaborate on some of the ethical issues that are associated with, or the ethical limits of enterprise risk management. I appreciate it.
I think by comparison, the Ford Pinto situation is simpler because clearly there's a responsibility on the part of Ford to produce safe cars. But there is a problem. How do you know when a car has a defect? It also arises more recently in the case of Toyota. Because auto accidents are going to occur from a variety of causes. And some of these show no design defect, others do. So you need to sort of look at the data to determine whether indeed there is a problem. And my understanding is that the officer Ford who's responsible for determining this, Dennis, what was his name? Boatright. No, not Boatright. That's the Challenger. Well, anyway,
who's now teaching back at Penn State, maintains to this day. Looking at the data, he would come to the same conclusion. So that's a problem of modeling and being able to determine from the data, indeed, whether there is a problem. And the same point can be made about VAR. In book, read so many books, which one does it come from? Oh, I'm just starting reading Joseph Stiglitz's book, Freefall. And he points out that, there's an article in the New York Times by Joe Nocera on VAR, pointing out that on Wall Street, Salomon Brothers is credited with having seen the problem with the real estate market, in part because they did use VAR, but they didn't just go by the number. What they looked at was the trend. And they saw the VAR number, even though it was still very good, was trending downwards. And so they asked, well, what's the cause of this? And through a lot of brainstorming and using, again, other evidence, they determined that they thought the housing market was going to fall considerably. So it's not simply a matter of the models that you use, but also how you interpret them. Some looked at VAR and thought the market was just great, that their risk was relatively minor. Others, like Goldman Sachs, saw the problem. But in the case, again, in the case of Ford, the responsibility for safety is very clear. I think one of the problems in the current financial crisis is that the responsibility has shifted. So when banks began, instead of originating mortgages, which they then held to maturity, that they would sell these to be put into CDOs. As a result, they not only had little incentive to look at the creditworthiness of the borrowers. They also said that's not our responsibility, because now the ultimate investors who buy these and the rating agencies are the ones who are supposed to assess this quality. So we'll simply make the loans. And again, there's nothing wrong with subprime loans under ordinary conditions. Most of the borrowers are not going to default. As long as we know what the default rate is, we can then price that and sell the securities. And there'll be many people who can get loans who will now have homes and will be able to pay off the loans who could not before. So I think there's a great benefit in securitization. But one effect of that is to transfer the responsibility from the bank under the originated to hold model to the rating agencies and the ultimate investors. And so banks serve a role of, again, intermediation, whereby they assume the risk and also monitor that risk. That, to a great extent, has now been transferred to essentially fund managers, people who manage your pension fund, your mutual fund, and so on. The trouble is they failed, partly because of failure by the rating agencies, but also, I think, because they didn't quite realize that we now have that responsibility. So the problem we're dealing with may be a temporary one. So as responsibility is transferred, it has to sort of click that the responsible parties have to recognize and then effectively bear their responsibility.
Okay. Is this on? No. Let me just see if I can understand this. There were examples in the press of banks and loan officers loaning people money to buy an $800,000 home when they were only making maybe $20,000 a year. I mean, I know the press sometimes finds the most radical examples, but how does enterprise risk management look at something like that? Surely that was going on quite broadly around the country, if not around the world. Would a system of ERM catch that sort of thing? Should it have caught that sort of thing? Is that an example of an unknown where you lots of people going out and loaning people money to buy houses they can't afford, even under instruction, perhaps unethical instruction, to make the loan because there was pressure on the part of the government to say we want to make sure everybody has a house and so on and so forth. Is it right for us to say that we made the assumption that houses would always go up? Is that not too simple? Because surely all of these things were going on where people knew, banks knew, that the people who worked in the banks, the mortgage officers must have known that these people could not possibly afford these houses on the salaries they were making. And then, is it not the case, and perhaps I'm wrong on this, but I had the impression that banks then bundled up all of these mortgages, which surely if they had some sort of an analyst there to look at what was going on, they would know was sort of junk, just pure junk, that they went ahead and then sold as securities, which then collapsed and investors got killed on. Is that, where am I going wrong with understanding the story?
Okay, there are junk bonds that trade today, so let's back up. Certainly there was a great deal of predatory lending and also predatory borrowing, which was potentially a very wild bet on the direction of the real estate market. So I don't want to defend the most extreme cases, but let's not be too quick to criticize the activities of the banks. Because let's look at it from the point of view of the borrower. I have a certain income, and I can afford, by the typical criteria, I can afford a house at a certain price. It used to be about 3 to 1. Then it moved up to 4 to 1, 5 to 1. It peaked, in some cases went to 6 to 7 to 1. Can I really afford that house? Well, I'm looking at this house as a kind of investment. I want to make some money off of it. So what's the worst that can happen? Probably the worst that can happen is that if this is a balloon loan or a 228, which is going to increase in payments later on, well, I'm doing well in my job. I'm going to be earning more in the future. Furthermore, this house is going to increase in value. So if need be, I can refinance, take some of the equity out and use that to pay down the loan. Or the worst case scenario is I can sell the house. Because again, the house is going to be worth more. So I'm going to be no worse off. So from the point of view of the individual buyer, this was a great gamble on the direction of housing prices. But there were a number of assumptions there, that housing prices would continue to rise, that I could always refinance, or if necessary, I could sell. And so worst that can happen is actually very small. Furthermore, there are going to be a lot of these buyers who are going to, again, be able to successfully pay the mortgage. Some are going to fail. Well, let's look at what's the percentage. Percentage might be 20%, 25%. It doesn't really matter. If we knew that these loans would fail, we should never make them in the first place. But if out of 100 loans we know that 25 will fail, we don't know which 25, well, let's give a loan to all 100 people. And again, the worst that can happen to those 25 is that they eventually have to sell, their equity will be wiped out, but that may be a reasonable investment for them to make. So, but again, it points out that all this was based upon a number of assumptions that turned out to be faulty. And they turned out to be faulty, the fact that they turned out to be faulty had a number of consequences. One is, for example, of course, you can always sell a house, unless the defaults are correlated. So if everyone tried to sell a house at the same time, then of course house prices are going to go down, it's going to exacerbate the problem. So what we failed to anticipate was the problem of correlation, which again undermined the assumption that we could always sell, which again underlined the argument for securitization. So I would maintain that securitization provides a great benefit, and that many people are going to be able to get loans they couldn't get otherwise, either because of credit standards, because of credit rationing by the bank, which might have been too high. Also, once we securitize these, we can draw from the whole world market. We can get money from the Chinese to provide for home mortgages. So there are a great many advantages. But again, they turned out to be built upon not only false assumptions, or mistaken assumptions, but when the crisis came, again, all the models we had developed turned out to be faulty precisely because everyone was trying at the same time to sell houses, and also there's a lack of liquidity. We couldn't, again, get loans. So there's a lot of bad luck there. But I think there's a lot of sound, well, I think much of the idea behind securitization is sound, again, if we accept the assumptions. So I view this, again, there was some predatory lending, some predatory borrowing, but by and large, a great many of the people who got subprime loans, I think that the theory behind it is basically sound. It just turned out we had a lot of bad luck.
We have time. No, we don't have time. I was going to say we have time for one more question, but it's after 5. So could we give John another great round?